Does anyone else have that uncle that thinks that playing the lottery is their best chance for retirement? Did you know that your chance of winning the Powerball jackpot is around 1 in 300 million? And that's exactly why Uncle Rico is gonna be working till he's 90. For today's video, I'm going to review the top 7 monthly paying dividend ETFs, where these exchange traded funds, or ETFs, pay out every single month. I am certain that most all of you know that dividends help create a compounding growth effect, or they can be used to supplement your income. But an item that most of you aren't aware of is that they don't all create dividends the same way. And that's why I'll break down the different types of dividend ETFs, the top pitfalls to watch out for, and then I'll provide the top unique 7 monthly paying dividend ETFs. And just so that you understand how much effort goes into this kind of video, I'm starting out with 22 monthly paying ETFs, and I'm creating an objective ranking system to provide you the top unique 7. And no, I am not suggesting someone would want all 7, but to have a mix of different strategies between dividend ETFs, well, that's not a bad thing. So, what exactly are these monthly dividend ETFs? Think of them as an investment fund designed to pay you, the shareholder, income every single month. They can do this by holding a mix of different things to generate that type of income. Maybe it's stocks that pay out dividends, bonds that pay out interest, or even using strategies like selling options contracts to generate money that's called premiums. And if you want a great understanding of how options contracts work, I created this Options 101 video to break it all down for you. I have gone out of my way to make this as easy to understand as possible. In either case, the fund collects all of this income, which might arrive at different times, and then they bundle it all up and it pays out relatively consistent amount each month. Why monthly? Well, it smooths out your cash flow if you're living off that income. And if you're reinvesting, getting that cash monthly lets you potentially buy more shares more often, which can really speed up the compounding effect over the long time period.
That is awesome!
Now, not all of these ETFs work the same way. Some simply hold a basket of high dividend stocks or bonds, others get more active. And you'll hear about funds like JEPI that use strategies like selling covered calls. Think of it like this. They agree to potentially sell stocks that they own later at a set price, and they collect a fee or a premium for making that promise, whether they sell that stock or not. And this generates extra income right now, today. Now, said another way, it's like you owning a really cool video game, and someone really wants the chance to buy it from you next month for $40. You agree. They give you $5 right now for that chance, whether they end up buying the game or not. And you get to keep that $5 premium today. Then you have funds like HNDL, which are a fund of funds. They actually build their portfolio by holding other ETFs to get income and diversification. So there are different engines under the hood. Then there are some funds like iShares Preferred and Income Securities ETF that are based on preferred stock. And it's a hybrid between a bond and a stock. Preferred stockholders get paid before common stockholders, but preferred stock funds get hammered in a bad way when interest rates are high or climbing. Before we get into the specific funds, I really need to stress some pitfalls that people need to watch out for with dividend investments. It is never just about picking the fund with the highest yield number. That big percentage, it may look tempting on paper, I get it. But sometimes an extremely high yield is really just a warning sign. You have to ask yourself, is this sustainable? Can it pay this amount for decades? And if it sounds too good to be true, then yeah, it probably is. And this brings us to a critical concept, return of capital, or ROC. And it sounds okay, but usually isn't really great for long-term growth. ROC means the fund isn't paying you entirely from its earnings, like dividends or interest received. Instead, it's partly just giving you back your own invested money and just calling it a dividend. While it does boost your cash flow today, it's eroding your principal, the amount that you initially invested. That's not good. And over 10 or 20 years, well, that can seriously hurt your growth, especially if the stock or fund goes down to zero. So how can you spot this? Well, you need to look at the fund's distribution details. See if ROC is a regular component. Also, just keep an eye on the fund's net asset value, or NAV. Basically, it's the underlying price per share. So if the NAV, or price per share, is consistently trending down, even while paying a really high dividend, yeah, that's a massive red flag. It suggests that they might be paying out way more than they earn. possibly using the return on capital. Another item, you need to understand the strategy. Those covered call strategies like a JEPI or JEPQ, they generate great income, but they often cap your total upside. If the underlying stocks that the fund holds begins to soar or take off, the fund completely misses out on those big gains because, well, it agreed to sell them at a lower price, kind of like that video game analogy earlier. And that's a major trade-off if you also want growth. Some funds might also hold riskier assets or be concentrated in volatile sectors to give you that high yield. Once again, you need to lift the hood and see if the risks align with your comfort level. And the last pitfall is taxes matter. Those monthly payouts, especially if they're coming from bond interest or option premiums, are often taxed as ordinary income, potentially at a much higher rate than long-term capital gains. Just for reference, here's a chart of capital gains versus taxes on ordinary income. If you brought in $200,000 and are married, you could go up to the 24% bracket from income tax or 15% from capital gains. That's a huge difference. In a taxable account, this tax drag can really add up. So holding these in a tax-advantaged account like an IRA or a 401k, if possible, can make a huge difference. Me personally, I only hold my high dividend investments in my 401k. So based on all of this, there are some common pitfalls that people fall into. First is putting all your eggs in one basket. Don't bank on one asset every time. Make sure that you have the right amount of diversification. And clearly, there can be too little and too much diversification. It's up to you to find out what's just right. Then we have the high yield money grab versus the total return. And keep in mind, the total return is equal to the yield plus the price change of the stock. So a 10% yield is less impressive if the fund's price drops a negative 6%. So that would give you only a total of a 4% return. Instead, a 4% yield with a 5% price growth happens to be a 9% total return, which is much better in the long term. Then there happens to be a lack of strategy knowledge. Knowing how the income is generated and the associated risks, like capped upside or interest rate sensitivity, these are vital points. The next pitfall is timing dividend payments. So buying right before and then selling right after usually doesn't work because the share price typically drops after the dividends have been paid. It's often just a lot of churning for not a whole lot of gain. And that leads to our sponsor, ADUR Clean Technologies, a Canadian chemical technology company which is commercializing its patented hydrochemolytic technology to address global environmental challenges. HCT transforms low-value feedstocks like plastic waste and heavy crude oil into valuable resources such as chemical precursors and renewable fuels with up to over 90% yield efficiency. ADUR focuses on recycling the significant portion of plastic waste that currently goes unrecycled, including 50% of plastics that end up in landfills. Through its customer engagement program, the company collaborates with major industry players, including Shell and Total Energies, to further develop its technology platform. ADUR's modular and scalable approach provides flexibility for companies to meet sustainability goals at the local level. Unlike other chemical recycling technologies, HCT operates at lower temperatures, accommodates more contaminated feedstocks, and it delivers higher yields with a gentler process. With 10 patents and applications, ADUR continues to innovate in this space. Their pilot plant is launching in Q3 of this year, and it will provide critical data for market adoption, followed by a demonstration plant in collaboration with NextGen Polymers, paving the way towards commercialization. Learn more at ADUROCleantech.com or in the link down below. Let's jump in with our top 7 monthly paying ETFs. And I have to start off with my criteria, which was that they have to have a minimum of a 4% yield. They need to be resilient in a downturn, and they also need to have solid total returns, not just yield. And they need to represent a variety of different strategies. And please remember that past performance, it's never a guarantee because data changes always and often. So please do your own research. Now, if you are curious, my objective scoring is based on the following. Dividend yield, I gave a weight of 25%. Total return, both the 3 and the 5 year, gave a weight of 50%. I also gave recession resilience over the past 5 years a weight of 15%. And lastly, the expense ratio, rated weight, was at 10%, where each of them get a score between 1 and 10, with 10 being the highest score. And I'm showcasing these ETFs in a randomized order, but of course I will be summarizing them at the end. Let's start with NEOS S&P 500 High Income ETF, where this holds an S&P 500 stock portfolio and it uses an innovative covered call spread strategy. It sells S&P 500 index call options while also buying higher strike calls. It does this to generate a very high monthly income while still keeping some upside potential if the market does rise. Its dividend yield is in the double digits and an expense ratio of 0.68%. The fund's total return is solid over the trailing 12 months and 3-year, but it hasn't been around long enough for a 5-year performance. This ETF is useful for investors who want strong income from US stocks, but they also want a little bit of participation in those market gains, so it gives a good balance between yield and growth. In the total ranking, this ETF came in with a score of a 5.33. Now on to the next fund of Invesco KBW High Dividend Yield Financial ETF, where it concentrates on high dividend stocks in the financial sector, primarily specialty finance companies like business development companies, and mortgage REITs. However, this comes with significant risk. It's narrowly focused in one particular sector and invests in highly leveraged, volatile companies, so its price can swing dramatically. Investors might use KBWD as a small satellite holding to boost their income, fully aware that its strength, huge yield, is paired with notable weakness. It's showing a yield of 13.9%, but it has a crazy high expense ratio of 2.02%. And the total return at the 3-year is flat, but the 5-year CAGR, and keep in mind this is compounded annual growth rate, is just over 14%. So with a near 14% dividend, the price of the fund has remained relatively flat or low at the past 5 years. And the overall score for KBWD is a 4.28. Moving on to our next fund, which is JP Morgan's Equity Premium Income ETF, which I think that you're all very much aware of, and it invests in a diversified mix of large cap US stocks with a focus on low volatility names, and it adds income by selling options on the stock portfolio. It offers strong regular cash flow and tends to be a little less volatile than a typical stock fund. But the downside is that it gives up some of the upside in booming markets. It's a solid choice for those who want stock exposure with a gentler ride and consistent income. The dividend yield is at a 6.9% and an expense ratio is relatively low. And the 3 and the 5-year total returns are decent. And JEPI rounds out the group with a total score of a 7.37. Let's move on to the next fund of Global X Super Dividend US ETF, which tracks an index of 50 equally weighted US stocks that sport very high dividend yields with a methodology that emphasizes relatively stable, low volatility companies, and it avoids extreme outliers. This ETF, well, it simply just collects the dividends from those high yield stocks, and it distributes them monthly, making it a very straightforward way to get diversified stock income. However, its weakness is that by focusing on these highest yielding stocks, it may hold some slower growth or troubled companies. Its dividend is a solid 5.8% and an expense ratio of 0.45%. And the total returns are weak at the 3-year and decent at the 5-year CAGR, giving this fund a total score of a 4.36. The next fund is the T. Rowe Price US High Yield ETF, and this is an actively managed fund that invests in US high yield corporate bonds, essentially junk bonds, earning interest from a portfolio of lower rated companies' debt and paying that out in monthly dividends. Because of this, it comes with a little bit of a higher risk than traditional bonds. The dividend yield is nice at 7.4% with an expense that is right in the middle. And the 3-year total return CAGR is decent with nearly 8%. And since it's newer, it does not have a 5-year report card. In our ranking, it had a final score of a 5.32. Now, before I cover this next one, just a reminder that I will be recapping all of these at the end. So let's move to the next fund of JP Morgan Nasdaq Equity Premium Income ETF, where it applies a very similar approach as JEPI, but on the Nasdaq 100 tech and growth stocks. It holds many Nasdaq names and writes call options on the Nasdaq 100 index to earn that premium income. And just like JEPI, it can lag in a roaring bull market since it's sold options to limit some upside. And it's concentrated in tech growth companies, so it's a great income complement to diversify an equity portfolio, but it is not a standalone solution for growth. The dividend is high at 12.3% with a low expense of 0.35%. And in looking at the total returns, the 3-year is decent at over 10%, and like several others, it does not have a 5-year history. And JEPQ rounded us out with a final score of a 6.23. Now on to the next fund of Amplify CWP Enhanced Dividend Income ETF. This ETF actively holds a selection of blue chip, dividend-paying stocks, and it tactically sells covered call options on some of them to generate that extra income, which is on top of its regular dividends. To me, this is the all-around general athlete in the dividend ETF world, because it does have a dividend of 5%, which is lower than most of them today, but in exchange for that, it has more upside potential compared to the more aggressive income funds, meaning that it won't pay as much as the highest yield funds, but it also doesn't cap nearly as much upside. And its expense ratio is right in the middle at 0.55%. And the total returns has a great history with a 3-year CAGR over 5% and the 5-year CAGR over 12%. And this fund has a total score of a 7.41. This DIVO fund has been one of my favorite monthly paying dividend ETFs for quite a while. Not only does it give you a great dividend monthly, but it also has a very strong appreciation in the price of the ETF. And I do need to point out that with a dividend of 5%, that's at the annual level. So for the entire year, it pays out 5% dividend. So if you have $1 million invested in this fund, it pays out $50,000 a year, or $4,166 a month. However, it does not pay out 5% each month. And this is something that a lot of investors get really confused about. Now, I do want to remind you that I have my free spreadsheet down in the description with all of this information summarized, along with all of the 22 ETFs that I had researched. I also have links so that you can look up the most recent information depending on whenever you watch this video, and you can do it without a lot of effort. Now, when we list all of these based on the objective ranking system, it does have DIVO in the very top position and JEPI is in the second, and so on and so forth. Now, I did pick an assortment of funds for this video based on differing strategies, so they weren't going to be all the same type. So if you think that a fund is missing, it's probably in the spreadsheet, and I highly recommend that you review it since it has all kinds of recapped information on each of the funds, like the strategy and how they perform during market downturns, along with all the ranking information. Now, I hope that you recognize all the work that I put in sharing in all this level of information, and I hope that you can help support the channel with a like and subscribe. As always, thanks again for watching.